Savings is what you are left with after spending all your needs. Whereas investment is when you put those savings in an instrument or in an area or in some kind of alternate where the money grows. I feel keeping money in your savings account, which gives you 3.5%, is not investment. The objective of saving has to be very clear. Now, somebody who's very risk taking can even go for stock markets. Within mutual fund, there is a method of investing which is called systematic investment plan, SIP. 17,000 crores per month is being collected in SIP only in mutual funds in our country at this point of time. Mutual funds popularity is growing, but what many people do not know is that it can be very risky. In fact, there is an old principle of investing. It's called 50-30-20. The more your corpus, the more your investments, the quicker you will become rich. So investments do not yield results overnight. Any investment which gives you a very short-term return, tag it down as most dangerous.
What, according to you, is the outlook for the market in 2024 and what sector should we bet on? Hi, I'm Shreyasa Vijay and you're watching Ritam. In today's dynamic economic scenario, saving money and establishing financial stability is very important. But many of us may have questions like how to invest, where to invest, what are the best ways to invest, and how to manage our financial portfolio, especially in our 20s and 30s. And to shed more light on all these issues, today we are joined by Mr. Sharad Kohli, who's a well-known economist and founder of KCC Group. Thank you so much, sir, for joining us.
My pleasure, thank you.
So I would like to know at what point of age and their career one should start investing.
Well, I would say in India, savings is inherent part of our culture. And from the times when children start getting their pocket money from parents, and this is a country where we used to have that good luck. So I think saving habits start from there, and parents inculcate this habit in children from there. So if you ask me this question as to when to start, I think whenever you're conscious of the fact that money is important for you, and money is related to your future, that if I save today, it will keep me protected tomorrow. So I think the right age is when you start understanding that money is of utmost importance to you. So I would say probably when you enter your teenage and you start getting your pocket money, you should start saving. And then thereafter, I think for rest of your life, saving is a process which should never end. Even people who retire, I think they become more conscious of saving. So for youngsters, I think saving is imperative. Although the youth of the country, they think that probably we need not save today. Khao piyo mauj karo. They probably feel like spending everything. But the fact of the matter is that the future can only be secured by savings.
So what are the best ways for savings as well as investments?
See, saving is something which is dependent on an individual's preference. So I'll tell you certain factors which are relevant to savings as to how do you decide as to where to save. Savings depends on your risk appetite. That is the first factor. When I say risk appetite, I mean how much risk are you capable of taking. That is the first criteria. Savings also depend on what are you saving for. You're saving for your holiday, you're saving for your car, you're saving for your house, you're saving for your retirement, you're saving for education. So the objective of saving has to be very clear. So first is risk appetite, then comes the purpose for which you're saving. Thirdly is the kind of return you want from your saving. Do you want a regular return or do you want your money to grow? Suppose somebody parks 1 lakh rupees in an X alternate, and you want this 1 lakh to grow to, let's say, 5 lakhs, 6 lakhs after some years. Well, some people say, no, we want to put 1 lakh, we want to get 1,500, 2,000 rupees every month. So it also depends on what do you expect from your savings and how frequently you expect the returns.
But if somebody wants to save for long terms, what are the alternatives available in the market that are easy to understand as well as track for the beginners?
Well, for laymen, I would say the easiest way somebody thinks of is putting the money in the bank, which I think every young person now, especially after government's Jan Dhan Yojana, where almost 50 crore accounts have been opened, rather more than that, 55 crores for that matter. I think practically every person in this country has a bank account. Even if you don't need it for savings, you need it for some or the other purpose. So I think the easiest way, what somebody thinks is savings. Now, a very important concept which I would like to clarify here, this is for the young people, that there is a difference between savings and investment. Savings is what you are left with after spending all your needs. That is whatever you earn and whatever you spend. So what is left is defined as saving. Whereas investment is when you put those savings in a instrument or in an area or in some kind of alternate where the money grows. So that is the difference between the two. So I think it depends on where you're putting the money. Now somebody who's very risk taking can even go for stock markets. Within stock markets also you can buy a share, sit on it for 6 months or 1 year. But then there are people who are very, very risk taking. What they do is they go into derivatives. There's something called derivatives in share market, where your investment can change in 5 minutes or 10 minutes. So it all depends on an individual's preferences. So some of the areas which people think are the easiest is bank, as I said. But I feel keeping money in your savings account, which gives you 3.5%, is not investment, because if it is generating 3.5%, it's definitely not investment. One step ahead of that is putting it in a fixed deposit.
Okay.
Well, that also gives you about, these days thankfully the interest rates have gone up, so that gives you about 7 to 8%.
Can you please explain what is fixed deposit?
Fixed deposit is the amount, when money is lying in your bank, you will often find your relationship manager in the bank or your bank manager or the banking clerk. They will come and tell you, why have you kept your money in savings account? Why didn't you make a deposit? So when you make a fixed deposit, is you lock your funds for 1 year or 2 years or 3 years.
Okay.
And if in savings account you're getting about 3.5% or 4%, they give you about 7 to 8%. So, but then the condition is that you should lock your funds for 1 year or 2 years. But I feel that in the current situation where needs of the youth are far more, you need a lot more money for your holiday, for entertainment, for maybe making your house, for marriage, for education, for traveling, and so on and so forth, for buying gadgets. So I feel that 7-8%, which is also subject to taxation. So if bank is assuring you of 7-8%, at the end of the day you may only be getting 5 to 6%, because bank ends up deducting tax on it. Okay. So the net return comes to 5-6%, which is, I think, if the inflation rate in the country is about 5 to 6%. So this means whatever you are earning from your fixed deposit, you end up spending because of inflation. So for the mehengai that happens, it takes away all your savings. So then comes the need where one should look for other alternates of saving. So I would say the easiest option is probably a bank savings account. Thereafter comes people who would like to be a little more adventurous. I recommend for people mutual funds, because what mutual funds do is you get the best of both ends. You get professionally managed investment managers, and you get some benefits of stock markets also, because there are two kinds of mutual funds. There is a debt mutual fund where you get a fixed return of about 6-7-8%. That is more or less like bank fixed deposit, slightly better. Then there are equity mutual funds who park your money in the stock markets. So there, if you put in a good mutual fund, you can even generate 15 to 20% of the money which you put in, which is a very, very handsome return. And then thereafter comes going directly to share markets. But then you got to be having a lot of knowledge of share markets, because I think share market requires high degree of expertise. So if somebody is not an expert, and also for share markets, you need to devote a lot of time. If you're not devoting time, and you are very casually investing on here and say, किसी ने बोल दिया यहीं लगा दो वहीं लगा दो, I think then there are chances of you burning your fingers. So therefore it's important that you understand the stock markets. Then some people also invest in commodities. There's something called commodities. There is zinc, copper, lead, these precious. Then precious metals. Let's not forget about gold, silver. Which a lot of people invest in. You've got sovereign gold bonds and other options where sometimes the returns can be better.
Okay, so which one is better, like physical gold or gold bonds?
Physical gold is difficult to handle. You'll have to keep it in your bank locker or probably home locker. There's a risk of it getting stolen. A lot of people do the mistake of investing in gold through jewelry, which is a terrible idea, because jewelry, you lose your making charges. In jewelry, you also lose your the purity. So I think if somebody wants physical gold, then go for the certified gold bars or gold coins, which are by government, by recognized banks. You can go from them. But the best is to go for sovereign gold bonds, which gives you the benefit of gold price increase along with safety. The only difference is that liquidity of sovereign gold bonds is not as good as coins or bars. Coins or bars you can go and sell to a jeweler anytime. But gold bonds, although they are traded in the market, but sometimes they are not very easy to trade. I'm being very practical, although the way it is advertised is that they are very liquid, but unfortunately they are not. They may not be as liquid as somebody feels. So if you can park for Excel at 5 to 8 years, I would say gold bonds. But if you want to park for 2 to 3 years, then coins and bars are also not a bad idea. Another option of investment which has been very traditional in India is real estate. Well, you buy a house or you buy a commercial property for investment purposes. For example, real estate, you may be able to invest, but then you may find it slightly difficult to exit sometimes. Because you cannot liquidate. If you bought a house, I can't sell it tomorrow. It might take me a few months, sometimes years to sell it. So I think, which is why I said that savings and investments happen as per individual preferences. And when I say individual preferences, I mean, how long can you leave your money? What is your risk appetite? How much are you expecting? I go back to the basic principles of investing, that how much are you expecting? What are your goals of investing? So that defines on where you're supposed to be investing the money.
Regarding mutual funds, every mutual fund comes with a warning to subjected to risk. So what are those risks and how can we identify those risks?
See, especially the mutual funds which are parking the money in stock markets. So because stock markets is exposed to a lot of vagaries. I mean, stock market fluctuates every day, by the hour, by 5 minutes, by 2 minutes. I mean, stock markets can go up and down anytime. Even as we talk now, the stock markets are moving up and down. They're very volatile. So that is a high risk investment. When a mutual fund parks your money in equity market, you are exposed to market risk, which is why when they throw an advertisement for mutual fund, they speak, as you rightly said, they speak a sentence very quickly that stock markets are, mutual funds are exposed to, subject to market risk. Please read your offer document carefully. They read that statement very quickly because whereas they want you to listen, they also want you to ignore it, because if you listen to it carefully, you may think twice before putting your money in mutual funds. You may wonder as to whether I should put it or not. But as I said, I mean, on an average, within mutual fund, there is a method of investing which is called systematic investment plan, SIP. And in SIP, you park a certain amount is invested in mutual funds every month, every fortnight, every week. You take out that money, it is automatically debited to your account and it is parked in the mutual fund. 17,000 crores per month is being collected in SIP only in mutual funds in our country at this point of time, which means it has become very popular with people. So therefore, mutual funds popularity is growing. But what many people do not know is that it can be very risky. That if an equity mutual fund, the market falls down, then there is something called the net asset value, the NAV, which is the value of the money that you suppose somebody passed 10,000 rupees in mutual fund today, and the NAV of the instrument grows, so your mutual fund may have become 12,000. It may have become 14,000, or it can also fall down to 8,000, 6,000 if the stock markets fall. Now, these are the two broad categories of mutual funds. In between, there could be there is a hybrid mutual fund, there is a small cap mutual fund, there is a large cap mutual fund.
So you were talking about SIP. People also invest in lump sum amounts. So which one is better?
I think SIP for me is better, which is why it is gaining more popularity. The advantage of SIP versus lump sum investment is that SIP, you even out the risk. Suppose in 1 month the stock market is up and your first installment of SIP goes. In second month, stock markets are down. Your second installment goes. In the third month, market is again up. So what would have happened over the period of 12 months? You would have bought the mutual funds at an average price. Because sometimes high, sometimes low, sometimes moderate, sometimes little high, sometimes little low. So over a period of, I would say, 12 months or so, you would have bought the mutual funds in bits, in smaller bits, at an average kind of price. So the chances of your suffering losses are reduced. 1, 2, your returns can get maximized, because when the mutual fund grows in the long run, I think you will be a gainer, because you have not bought everything at a very high price. You may not have bought everything at a very low price also. So it gives you a decent amount of return. So that's why I feel that SIP method is better. Plus, I think SIP is also becoming more popular because a lot of salaried people are investing. So every time you get your salary, which comes once in a month, a fixed amount gets deducted. So I think it becomes easier for a salaried person who may not be having a lump sum amount at his or her disposal at all times. I mean, you may not be able to collect that much of money. So SIP ensures that you're investing in smaller bits, investing regularly, and investing on an average price, thus maximizing your return in the longer term.
How much individuals from their salary should allocate to their wants, needs, and savings?
That's a very interesting question. In fact, there is an old principle of investing.
Yeah.
It's called 50-30-20. So 50% they say is for your basic necessities. You can't, without which you can't live. 30% is for your, I would say, going towards luxury. That is that 30% you may or you may not invest. Although the difference between luxury and comfort is now disappearing.
Yeah.
Because I think there's a very thin line between luxuries and comfort. So I would say 30% for your comforts, 50% for your necessities, and 20% should go for savings. This is the traditional principle, and I still believe in that. I would only add something to this, which is very important and which most young people forget. People consider savings as something which is left after spending on your needs and comforts and necessities. That is, for example, if I earn a salary of 1 lakh rupees a month, and obviously I spend on housing, I spend on food, I spend on holiday. So I feel if I'm left with 5,000 after spending 1 lakh, I'm 95 I've spent. So 5,000 is my savings. That is what most young people think savings are. But I would give you a mantra which will completely change the meaning of savings. I would put it like this: if your salary is 1 lakh, consider your salary to be only 80,000. The moment salary or your income hits your bank account, slash away 20%. Keep it in another bank account. Do not keep it in the bank account where your salary comes. Assume that your salary was only 80% of what you were getting. Why did I say this? Obviously, you would end up building your corpus, first of all. But let me tell you something which is very interesting about savings and investment, which very few people know. That we keep hearing about rich people in the world. Every young person wants to become the richest, the richy rich, or whatever you want to be, surrounded by wealth around you. The mantra behind wealth is that how did wealthy people become wealthy? Well, there is a old saying in Hindi, Maya ko Maya mile, kar kar lambe haath. The meaning of this is that how did the rich grow richer? How did the wealthy grow wealthier? The magic is that if you have savings, only money can earn money. Very rarely does somebody hit a lottery or somebody hits a very large amount all of a sudden, but those are very rare cases. Those are exceptions. Yeah. Most of the rich people have become rich because of savings. That the more your corpus, the more your investments, the quicker you will become rich. So first step is savings, then comes investment, and after investments comes becoming rich. Because the way you invest, how intelligently you invest, how sensibly you invest, and how much prudence are you showing while investment, I think only that is the only way to become rich. Otherwise, I found most of the young people, they keep dreaming of becoming rich, but unfortunately, I mean, I have a data with me also. 90% of them, 90 to 95%, never become rich. They may be earning well. So there's a difference between earning well and becoming rich. That is another very important aspect. Earning well is, a lot of people earn well, but are they rich? The answer is no. What is the definition of being rich? The definition of being rich is that you should have a very good asset portfolio. You have a house of your own, probably you have a farmhouse of your own as well. You've got a luxury car, you can afford to go on luxurious holidays, and so on and so forth.
So can someone maintain their standard of living just by investing money in the right places?
Absolutely. As I said, wealth is all about what kind of assets you have. Self-made people can only and only become rich if they have good saving habits.
So how should people manage and diversify their financial portfolio?
I think there is a saying in investments which says, do not put all eggs in the same basket. I find a lot of people, they have all their money in fixed deposits, which is bad. I find some people who park everything in mutual funds, which is also bad. Same goes for stock market, same goes for gold, same goes for real estate. So a good investor is one who spreads the risk across all these asset classes.
Okay.
A little bit in savings account is required, obviously, because you do your day-to-day spending in the era of UPI payments. I mean, if you have a zero savings account, how will you make your daily expenses, isn't it?
Exactly.
So, but only keep that much money in savings account which you need probably in a month. Do not keep more than that. Little bit in fixed deposits, because fixed deposits give you liquidity.
Yeah.
Liquidity is a very important factor. It's another one of the principles of investing which I spoke in the beginning, that do you need funds immediately or do you not need funds immediately? So you need liquidity, keep in fixed deposit. With fixed deposits, you can go to the bank anytime, ask them to liquidate. In fact, these days you get sweep in deposits. Sweep in deposits is where you keep your money from savings to there, and if you need anything, they will only break that much. The rest will remain as a fixed deposit.
Okay.
A little bit in mutual funds. Between mutual funds, again, have a balance of debt and equity mutual funds both. Something which you don't need for a very long time, I think keep it in debt fund. Something which you want to play around with, let's say 20-30% of your mutual fund portfolio should go to equity.
Okay.
Then I think be in touch with an advisor where you can dribble around a little bit with the stock markets also. I would say 10-20% of your total investable portfolio can be in stock markets also, under guidance of an expert.
Okay.
Initially you need guidance, then after some time you can probably start doing it yourself as well. Then I would also suggest youngsters to keep some money in gold, because gold has got a very bad friend, and that friend is geopolitical tensions.
Okay.
Every time there's a war breaking out somewhere, and in the era we are living in, an era of war actually. Some people say we have already in the initial stages of third world war. Look at what's happening in Red Sea. Look at what is happening in Russia, Ukraine for last 2 years now. Look at what's happening in Gaza. North Korea, South Korea, always tense. America, China tense. China, Taiwan tense. There is so much happening around the world. The entire West Asia is boiling at this point of time.
Exactly, and that has a huge impact on economy.
Exactly. So gold is considered as a safety measure in the times of war. So with the war tensions growing, I think gold is going to catch up. Then a little bit in real estate is also not a bad idea. I think a lot of people, they want to buy a house and they stop at that. Okay, I wanted a house and that's it. I don't want to play. But I think if you look for quality commercial real estate, you can buy a small shop, give it out on rent.
Okay.
You can buy a small office, give it out on rent. And apart from the rentals, the rental returns may be 3-4%. But capital appreciation which will happen if you've chosen the right location, if you've chosen the right developer, if you've chosen the right brand name, the right city, I think you would be able to build on that capital. You will be surprised to know that in India, particularly in the metro cities, now even in the villages, most rich people, I'm leaving out the uber rich. When I say uber rich, I'm talking of Mr. Adani, Mr. Ambani, Mr. Tata, Mr. Birla. Most rich people in the cities are rich because their properties have grown by many times.
Exactly, yeah.
So I think one should not run away from real estate, but the only magic mantra is that you should have a long-term vision. Most people, they do mistake in real estate investing is they look at a very short term. Well, in short term, nobody can become rich overnight. So investments do not yield results overnight. Any investment which gives you a very short term return, tag it down as most dangerous. For all the asset classes that I named, I think one should allocate. Now, how much percentage should be allocated? If that is what your question is, this would depend upon an individual's preference.
Okay.
You know, as to how long do you not need your money? I mean, can you park it for 5 years, 10 years? I would say park it in a mutual fund, go for real estate, buy gold and keep it. Forget it. Keep it in your, keep the gold bonds and so and so. If you need more liquid funds, or the youngster who says, I'm probably going to get married, I need for higher education in the times to come, then I think a little bit in a fixed deposit would not be a bad idea, because so that you can access the funds immediately.
Coming back to investments, our parents used to invest in mostly traditional ways. But as gradually income increased, people started taking risks. So according to you, which one is better, like traditional ways or modern investment ways?
Well, the answer lies somewhere in between.
Okay.
our elders were not totally wrong, because they were very conservative and they have built a very health. In fact, they are leading a very healthy retired life, because they had their savings. You get your large amount of provident fund amount, or you get your large savings on retirement, that is why they are able to live comfortably. Whereas not being adventurous is also not a very good idea. So I would say the answer to this question lies somewhere in between. Midway, because do keep some traditional, as I said, do keep some fixed deposits. Fixed deposits these days are not giving a very bad return. 7 to 8% return is not a very bad return. But also do not be averse to mutual funds, stock market. Also do not run away from real estate. Real estate after COVID has done very well.
But what about people who are living in metro cities like Delhi, Bangalore? They struggle with the question whether they should continue living on rent or they should buy a house. So what should they do?
I think it is all a matter of how much return your funds, your corpus is generating. If you're generating a very healthy return which is covering your rent and giving you a surplus, then it's not a bad idea to stay on rent. But then principally, I think having your own property gives you a lot of advantages. Not just saving the rent, but you're also adding capital value to your investment. Suppose you bought your house for 1 crore, let's say in Delhi, NCR, in Noida somewhere, you bought for 1 crore 5 years ago. And today that house is worth 1.75 crores. So you've also added to your net worth. Tomorrow you might sell that house and you can buy another house for 1.25 crores and end up saving 50 lakh rupees as your profit. So I think having your own property is always a good option, even if you have to take a loan for that, because the loan interest would be as good as the rent you're paying, maybe a little bit here and there. So I feel that getting your own house is far better than staying on rent at any point of time. And I think for every individual, there is a point in life where you feel that I should at least have a property of my own. I think the youngsters, they start realizing this. The financial influencers, the problem is that financial influencers themselves are very young. So somebody has to be going through that stage of life to understand that I should at least have a property of my own. And I've seen all youngsters, the moment they cross 25, 30, they start feeling, yaar, ab to ek apna ghar hona chahiye, kahin na kahin to hona chahiye, kab tak dhakke khate rahenge. Those kind of thoughts, they hit you. Also, I think it depends on your employment, as to where you're employed, where you're settled down. If somebody has bought a house in Mumbai and tomorrow he moves to Bengaluru, I think he would like to sell the Mumbai house and probably come down to Bengaluru for that matter. So I think, but buying a house is never a bad idea.
How should people stay informed about the market trends and what stocks they should invest in?
I think stocks is a very, very tricky area, as I said. I feel person should start with paper trading, paper investing. Paper investing, do not invest real money. Create some imaginary money with you. Invest. Try it out for a few months.
How does that work?
Well, just imagine that suppose I have 5 lakh rupees, just note down in your diary that I have invested, let's say out of that 5 lakhs, 1 lakh in Reliance, 1 lakh in HDFC, 1 lakh in Infosys, 1 lakh in TCS. So keep this portfolio with you. Observe, see how it does for 6 months. Keep buying and selling. You're not losing anything at the end of the day. See how much that 5 lakh becomes. What the mistake people do is they go by hear and say advice. So I feel hear and say advice in stocks is a very bad idea. There is so much of material available on the internet these days. YouTube has got so many videos. You've got social media. You've got people who do disseminate a lot of basic knowledge about stock market. So get that knowledge first. I think for stock market, I would say a lot of preparation is required before you start riding the stock market, because stock markets can give you very big return and you can also lose very quickly. So something which is so dangerous, I think requires a lot of research, a lot of preparatory time, which I would suggest youngsters should do before they jump onto the stock market bandwagon.
So what about the youngsters who are in their 20s or 30s, but they want to plan for their retirement? What advice would you give to them?
Well, the magic word is start saving. And the problem with youngsters is they don't think about retirement. They think retirement is too far and I'm never going to be 50, 60, 65. If the youngsters have a very futuristic outlook, I think they would start saving. So the magic mantra that I gave, that slash off 20% of your income immediately, slash off 20% immediately, so that you are able to park it separately. That will help you in investing. That will help you in emergency. That will also help you in building your retirement fund.
Are there any government schemes also specific that are doing good and we can invest in?
Well, government, there are two ways you can invest in the government schemes. One is, of course, Reserve Bank of India has opened its treasury bonds for people with minimum of 10,000 rupees.
Okay.
You can go to the RBI website. They keep launching these treasury bonds. Second is Government of India does through post office. I think post office has got a lot of schemes. There are post office time deposits. There's post office monthly income plan. There are a lot of post office schemes, but not too many options from the government, I would say. Sovereign gold bonds come from the government, but otherwise government doesn't offer too many options. Most options are available on private platforms.
What, according to you, is the outlook for the market in 2024, and what sector should we bet on?
I think the market has been peaking across the world, and I feel a correction from here would not be a surprise. But as far as the sectors are concerned, for long-term investors, I would say defense sector, information technology, FMCG, power and energy, and electric vehicles. These are the sectors which are definitely going to be in demand. And I think, but the only care that investor needs to take is have a long-term view. If you go for a short-term view, I'm afraid none of the sectors may work, or something may work, something may not work. But be conscious of the fact that the geopolitical tensions around the world are building. So any knee-jerk reaction can come to the stock markets, which can shake away your mutual fund net asset values or your stock market portfolios. So one has to be very careful, very observant in investing from here on.
Okay, sir. Thank you so much for talking to us. It was a valuable conversation.
Thank you so much.